Welcome back to Market on Close. I'm Sam Vardis, live from the floor of the New York Stock Exchange. Shares of luxury automaker Ferrari are under heavy pressure today in reaction to announcements at its Capital Markets Day presentation. The company raised long-term financial targets, but was still below consensus estimates. It also slashed its sales guidance on electric vehicles, and shares have dropped to 6-month lows off the back of that. So it is time for overlooked stocks. I'm joined by Tsilis, senior markets correspondent, to get us across that one. I suppose the one thing that really stands out to me, George, is that when you go to places like China, the thing that really hits you is just how quiet it is because of all the EVs. You don't really associate that with Ferrari. That was just my takeaway and my first thought that popped into my head. But talk us through what we've heard from the company and what you make of the reaction in the stock today.
Yeah, so kind of a mixed result. Obviously, the stock is down a lot today as a result of what they talked about in their capital markets day. But I mean, you got to think about Ferrari as a premier, global recognized luxury brand, not just automobiles, which are custom ordered vehicles. The total volume of sales for the company, at least last year, was around less than 13,700 units. So that's an extremely small number. So the point is that anytime there's some challenges with either new vehicles being sold or maybe some pushback in terms of the electric vehicle progress that the company is expected to make, that's going to create some challenging revenue environment for the business. They also have, of course, their other divisions, which include financing, leasing services, as well as licensed luxury goods divisions, which are certainly helping out the revenues. But if you look at, when the company reported revenues last quarter, they were guiding for around 7% of sales growth for fiscal year 2025. But one of the things that they talked about in their capital markets day is that they're looking at their longer term projections, which are right around 5% top line sales growth. But also they're looking at pulling back the expected delivery date for an all electric vehicle into late 2026. And the total volume of electric vehicles as a percent of total vehicle production was estimated prior to date to be around 40% by 2030. Now it's cut down to 20%. Now, some would say that that's actually a good thing considering the legacy nostalgic brand that Ferrari is, which again is the sound of the vehicle, which is phenomenal. And maybe they're not essentially moving into the electric vehicle space as aggressively because of that. But if you look at the financial performance of the business in terms of sales growth, those numbers are coming down slightly. But the EBITDA growth, this is where I actually saw some challenges because they guided for EBITDA margins between now and 2030, somewhere between 30 and 40%. Now, that's quite a wide range, which suggests to me that there's really some uncertainty around the cost of goods sold, capital expenditure expenses, as well as R&D expenses associated with maybe changing their lineup projections to go a little bit more of the internal combustion engine versus electric vehicles. So maybe the plan had been to expand electric vehicles to increase the total volume, to achieve a little bit more scalability in total production and sales. That looks like it's being pulled back. And so I think what's happening here is that the market is sort of reevaluating or realigning valuation for the business contingent upon the widening out of the EBITDA growth estimates, which are still quite high, between 30 and 40%, but nonetheless, the range seems to be rather large, and that's, I think, spooking some investors.
Right, yeah. I mean, I've heard a little bit of commentary about this today, and one thing that really stuck out was also the fact that this stock is seen as expensive, so any sort of form of conservatism is being punished here.
Yes.
But to your point also about, lowering that EV sort of outlook and that target now, this is not an isolated case either with Ferrari. I mean, we've seen other companies, I believe Aston Martin, also sort of dialing back their plans, which I don't know whether it's addressing what they're seeing as far as demand in the market, etc. But, sort of what's your read on this when you look across the broader sort of auto space?
Well, I mean, my evaluation, at least in the luxury performance brands like Aston Martin and Ferrari, is they're legacy companies, and moving to an EV type model is kind of challenging. I know Porsche has done that. Tesla, of course, maybe releasing their revised Roadster. So that's a sports performance luxury brand or vehicle. But Tesla's going to have more scalability, and they don't anticipate to sell very many units of that vehicle to consider as well. They're not going to sell that many. So Ferrari's not selling very many vehicles, so they have to maintain premium price points. But they also have to maintain premium price points with mitigation of capital expenditure and R&D expenses. And so, maybe Ferrari is not looking at the projections in terms of EV sales as aggressive going forward, but maybe they have some costs embedded in those projections that need to be recalibrated. So it's kind of tricky because, again, they need to maintain high price points. Their business model is not high volume. And so, again, the challenge is are the higher price point consumers going to migrate from the ICE vehicles, internal combustion vehicles, to the electric vehicles? And it looks like maybe there was some survey apprehension, and that's why Ferrari's pulling back on their EV production, guidelines. And again, maybe that's why, again, we're starting to see the recalibration of the stock relative to the earnings, because once again, as you mentioned, Sam, it's trading around 46 times this year's earnings, 39 times next year's earnings. Historically, it's over 40 times. So it looks like it's recalibrating, considering some of those production volume pullbacks that the company's anticipating.
Well, I assumed that it was more than the lackluster performance we saw at the F1 in Singapore. So thanks so much for getting us across that one today, George.